So imagine a newly public company intentionally taking a margin penalty just to hoard factory workers ahead of schedule. It is March 16th, 2026. Today we are looking at Forgent Power Solutions, ticker FPS, and their Q2-26 report, which is actually their very first quarter reporting as a public company. They build the massive electrical systems and e-houses that keep data centers running. Top line came in at $296.4 million. That is, well, it is up 69% year over year, Nero. The demand signals here are completely wild.
Yeah, the demand is the whole story. The income statement is almost a distraction. Look at the bookings. They booked $762 million for the quarter alone. That gives them a book-to-bill ratio of 2.6. You just do not see that kind of velocity in physical manufacturing. They're essentially catching the full brunt of the AI power bottleneck.
Right, which is incredible to watch. And just before we get completely carried away by the hype, I should drop our usual reminder that this is just our personal opinion and absolutely not financial advice. But looking at the profitability, they actually reported a slight GAAP net loss of $0.1 million.
Right. That gap loss is basically just accounting friction. They took a $10 million write-off on some deferred financing costs from refinancing a loan. The actual operating metric here is adjusted EBITDA, which came in at $60.4 million. That is roughly a 20.4% margin. And honestly, it would have been higher.
Wait, this is the factory worker thing, right? The hiring penalty I mentioned.
Exactly. Management decided to take about a $6 million combined hit to gross margin and EBITDA simply because they're pre-hiring. They're bringing on labor for new factories that are not fully ramped up yet. They're paying for underabsorbed overhead just to guarantee they can crush competitor lead times when the orders actually ship.
Which is such a bold bet. But it makes sense when you look at what's happening on the ground. Data centers are transitioning from these older 500 amp power units to massive 1600 amp setups just to handle the new Nvidia chips. You literally cannot plug in the next generation of AI without the grid upgrades Forgent provides. And I think the market finally digested that reality during the call.
Yeah, the stock action was pretty fascinating to watch. It had been bleeding down late in the quarter, dipping near the $31 level right before the open on earnings day. But once that 11 a.m. call started, it just rocketed.
Yeah, total reversal. It spiked up, peaked above 36 during the regular session, and ended up closing extended hours around 35.21.
It turns out revealing a $1.5 billion backlog tends to fix your momentum problem.
Right. Well, $1.5 billion in the pipeline will usually do the trick. All right. There's a lot going on with their aggressive product expansion, so let's get into the details.
It really is about expansion, but not just building new plants. What fascinated me was how they are expanding the actual footprint of a single customer order. They have this, I guess you would call it a wallet share pull-through strategy that is just completely compounding their revenue per site.
Meaning what exactly? Like they're selling cables along with the transformers?
A bit more sophisticated than cables. Historically, they are known for medium voltage transformers, which are, well, they're incredibly hard to source right now across the entire industry. So Forgent is using that leverage to force, or at least highly encourage the customer to buy the entire downstream electrical suite. Low voltage components, the protective e-house shell, all of it.
Ah, a bundle play. You want the critical piece, you have to let us build the whole room.
The math on that is actually staggering. The CEO pointed out that a data center customer typically buys $6 or $7 of low-voltage equipment for every $1 of medium-voltage gear.
So capturing that whole chain means every core order scales exponentially compared to what they were doing just a few years ago.
Right, yes. And they shared a story on the call that really highlights this. A major client came in looking for a standard medium voltage setup, just their bread and butter. But the engineering team completely shifted the scope and took over the entire low voltage design and integration. That single deal ended up being 7 times its original intended size.
7 times? Geez, that is an entirely different business model. You were moving from a parts vendor to a total system architect.
And it was for an ultra-complex 180 megawatt system, which they got fully designed and integrated. And get this, delivery is happening over just a 5 or 6 month period.
Which perfectly connects to what we discussed earlier about them hoarding factory labor. You cannot promise a massive custom system in under 6 months unless you have people already standing by on the floor.
The pre-hiring is the product. Gary Niederpruem actually had a quote on this that I thought distilled their entire operational strategy. He said, and I'm quoting here, "When you can consistently beat the competition on lead time, it becomes much easier to win."
Because these data center operators are bleeding cash if their billion-dollar facilities sit idle. The cost of waiting is way worse than whatever premium Forgent is charging for the gear.
Precisely. They do not care about the hardware premium, which actually brings up this other fascinating metric they dropped, their average manufacturing batch count.
Meaning how many identical units they run at once on the line?
Yeah, for typical peers making standard electrical products, you're running batches in the hundreds or even thousands, just mass-producing standard metal boxes. Forgent's average batch count right now is 15.
Just 15? That sounds like an absolute logistical nightmare. How do you even drive margin on batches that small?
By charging strictly for the engineering. It proves they are essentially an engineer-to-order business. About 90% of their revenue is completely custom. They are not selling commodities that sit on a shelf. They are selling bespoke micro-batches tailored directly to one specific site design.
Giving them immense pricing power because nobody else is going to step in and replicate 15 highly custom units on a 5-month timeline.
Exactly. It completely insulates them against commoditization.
I actually love that framing. They're basically the bespoke tailors of the electrical grid, just cutting massive steel power suites to order.
Bespoke tailors making 100-ton substations. Fair enough.
Hey, whatever fits. But honestly, managing a bespoke manufacturing process at that kind of velocity has to put an unbelievable strain on the organization. How are they planning to structurally absorb all this demand without the wheels coming off in the second half of the year?
By throwing an absolute wall of capital at new capacity. They are wrapping up a $205 million expansion by this June. And the fascinating part is that investment builds out a manufacturing network capable of supporting up to $5 billion in run rate revenue.
5 billion? Wait, their trailing 12-month revenue is barely $1 billion, right? That is a huge structural bet.
Exactly. It is a 5x capacity ceiling. They are essentially predicting a multi-year structural panic for infrastructure. But management actually backed up that confidence in their forward guidance. They are projecting second-half adjusted EBITDA to reach up to $185 million. Basically doubling their profit velocity. Ryan Fiedler explicitly told analysts, and I will quote him here, "We expect the vast majority of our current backlog will be delivered over the next 12 months."
Right, so that answers it. All those under-absorbed factory workers we just talked about, they finally hit full utilization in the back half. The margin drag flips directly into margin expansion.
Precisely. The upfront friction turns into free cash flow. Although I do think investors need to watch the labor math very closely next quarter. They grew manufacturing headcount 80% year over year. Management admitted that hiring ratio is currently pacing faster than revenue growth. If the macro supply chain suddenly chokes on raw materials, they are going to be paying premium wages on empty plants in Texas. That penalty gets heavy quickly.
Fair. Yes, that is definitely a real risk, but honestly, it feels like the sheer technology cycle gives them a pretty massive safety net. We touched on those new high-density server racks needing 1,600 amps. Older data centers literally have to rip out their entire electrical foundation just to turn the new chips on. It is forced obsolescence.
Yeah, exactly. It operates like a physical tax on the whole AI hardware transition. They do not just rely on new construction. The retrofit cycle alone could feed them for years.
Which is a brilliant spot to find yourself in just weeks after ringing the IPO bell.
Yes.
Well, I think that maps out the underlying story here beautifully.
Unless you're secretly planning to build an e-house in your backyard, Miro.
I'm pretty sure my local zoning board would notice a 100-ton power substation. I'll leave the high voltage to the professionals.
Probably a safe bet. Well, I think that is plenty to chew on for one episode. If you want these earnings drops to just automatically show up in your feed, go ahead and follow the show. We do use AI tools to help us sift through those giant financial filings, but the actual insights are just us thinking out loud. Send any ticker requests our way at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out, and we will catch you after the next call.
See you next time.